From the City of London for our audience worldwide, Bloomberg Real Yield starts right now. We begin with a big issue, COVID-related restrictions weighing on the U.S. labor market.
We are seeing a slowdown. We're seeing a weakening.
Deterioration follows from these renewed lockdowns.
You're seeing the impact of the pandemic surge here.
Definitely weaker than anticipated.
The Fed retains tremendous amounts of flexibility to respond.
The Fed is really the only game in town.
It's a reminder of how important the fiscal policy response needs to be.
Whatever that fiscal package is really going to dictate what the Fed does going forward.
A lot of expectations built into will they, won't they extend?
Will they extend the weighted average maturity? Yes.
I think that they have to.
Will they do it this meeting? Maybe.
They have to say to themselves, this is going to be forever.
It's a lot more uncertain whether or not at this point in the economic pandemic cycle, they need to spend that bullet.
They are going to do some things that are going to be more accommodative.
It's going to be very, very difficult for them to reverse that policy somewhere down the road.
Mike Swell at Goldman Sachs joining us on this from Goldman Sachs Asset Management. Mike, great to catch up with you, sir. Mike, let's start there. On Treasuries, on bad news being bad news for Treasuries. Is that your view of things, and how high can we take 10-year yields, Mike?
Great to be with you, Jonathan. I think that there's a cap on the Treasury market, and it's really a result of kind of looking away from kind of the short term, where there may be certain instances where people start to think about the growth post-COVID, where we see significant vaccine implementation, and then everyone thinks that we get back to normal right away. But we saw today in the jobs report, it's going to take a long time to get back to normal. The Fed's going to be on a hold for the foreseeable future, and as a result, I don't think you're going to see a 50 basis point increase in the 10-year rate. I think the probability of that is very, very low. People should kind of sit tight and recognize that rates are going to stay low for the foreseeable future. And today's report just proves that we're going to be in this kind of odd situation where equity markets are going to look forward, but you have policy that has to catch up. And there are a lot of people that are out of work and really struggling, particularly in the U.S.
Mike, I think everyone's really struggling with getting comfortable with what's happening right now. You need to get comfortable with what's going on around the world right in front of you and comfortable with the outlook at the same time. Mike, that's a really uncomfortable thing to do, to divorce the here and now from the outlook. What's your advice to people to do that?
Well, I think the most important advice, and this is true advice for individuals as well as for institutions, is to really be very thoughtful about long-term, intermediate term to long-term asset allocation, and stick with it, and be in situations where you see significant dislocations, you rebalance, but don't get overly caught up in the short term. And I know we love to talk about daily, weekly, monthly numbers, but you really, particularly in an environment like this, when we know that there's this very powerful vaccine that is likely to change the game 6 months and a year out, you have to be very forward-looking when you think about investing in it, and sit tight. Don't let the short term impact you from an investment standpoint. Obviously, from a personal standpoint and from a policy reaction standpoint, the short term matters a lot. I think something like today's number is likely to get Congress to potentially act prior to the end of the year, and also potentially get the Fed to get a little bit more aggressive on the easing side, despite the fact that the long-term...
Well, Mike, let's talk about the Fed side of things. If we could build on that, I think that was a lot of people's take off the back of this payrolls print, that what would happen, payrolls downside surprise, it would be the stimulant for stimulus down on Capitol Hill. Where does that leave the Fed at the next meeting in a couple of weeks' time, Mike? Do you think they have to do something around the asset purchase program?
I mean, there's a decent potential that in December they decide to extend the maturity of their purchases and try to flatten out the yield curve and drive longer-term rates down. Obviously, that has an impact on corporate borrowing. It has an impact on mortgage borrowing as well. And so there's a decent potential that they do that. But I think you got to kind of move away from thinking about one meeting and just think about what is the environment that we're in. And we're in an environment where we have a significant amount of people that are unemployed, despite the fact that we've had this risk asset, very significant V-shaped recovery. You've not seen it for a lot of individuals. As a result, it's going to leave the Fed on hold for the foreseeable future. It's going to take a long time. We saw in the 07-08 crisis, it takes many, many years to get back to full employment. And I think we're going to be in the same situation here in the U.S. So a lot of people have to get back to work. It's going to take an extended period of time. Inflation is not a concern over the course of the next couple of years. Expect the Fed to stay on hold. Expect the Fed to be accommodative. Whether it's something in December or you see more accommodation early next year, you're likely to see it.
Mike, big output gaps. You've made this point a couple of times when we've caught up. Inflation low, the Fed on hold. It won't step in if things get better. Let's talk about credit. Investment grade, you're overweight. High yield, you're overweight. The headline numbers, we are tight. Triple C spreads, I was looking at this earlier this week, are tighter now than they were before the pandemic. Mike, can you walk me through what's going on beneath the surface at a security level, whether there is still the disparity that existed 6 months ago? What are you seeing?
Well, first off, I would say that there is a big rotation going on right now in the credit markets. And initially, when COVID hit and we saw that there was Fed accommodation, everybody jumped into the easy money. They jumped into the investment-grade credit universe where people were very confident that you wouldn't have significant downgrades, you wouldn't have significant defaults, and the Fed was there providing liquidity. That easy money has already been made, and as you mentioned, credit spreads are back to where we were pre-COVID, particularly in the investment-grade universe. There still is the big debate, which we touched on earlier in this conversation, around how do we get through the short-term issue with regard to shutdowns, with regard to significant unemployment, and how do we then look forward 6 months or a year? I think that markets are starting to do that. And what you're starting to see is a shift in, and this is what we're doing in portfolios, we're moving out of where all the money chased the kind of very high quality spreads to really dig in deeply, bottom up, security specific, name specific, subsectors, industries that are likely to materially benefit from economic recovery second half of the year and as we go into 2022. And what you're finding is a lot of companies, due to the fact that capital markets have been incredibly open, companies have been able to bridge the gap. And that's the key of what the Fed and the federal government have to do for individuals. They need to bridge the gap between the inability to be able to work and the future world where we're going to see a stronger economy and people are going to get back to work. And I think what happened in the credit markets, and thanks to the Fed, they provided that liquidity to companies. So companies are fine. We're not going to see a high degree of downgrades from here. We're not going to see a lot of defaults because they gave companies access to capital markets to issue. We bought them. We took advantage of very wide credit spreads, and they're fine. But individuals are not. They don't have the same bridge. They had the bridge up until a couple months ago, until the accommodations were out. And really, the need for fiscal is there to get individuals back onto the other side. But it's very important as an investor when we're buying 5, 10 to 30-year debt. What we're doing is we have to look over the long term. And we think that the credit universe is pretty attractive. And right now, with the job numbers like today, obviously, it's not good news that we haven't seen the recovery that we want to see. But what it does tell you is that we're going to see accommodation, and we're going to see a much easier Fed for an extended period of time. That in combination with the prospects of vaccine having an impact on getting companies back to work and getting companies back to investing leads to a really good kind of credit environment, easy central banks, low rates, and a good enough economic environment.
Mike, just to finish on a point that you've touched on and I think is really important, it's on the maturity wall, on high yield and the maturity wall in, say, leveraged loans. I know it's something you've been looking at. Can you just add a little bit of colour, some clarity on the kind of dynamics that you think we need to pay attention to?
Well, we had in the financial crisis in 07-08, we had a significant issue where companies actually did not extend out their debt. The Fed was not as aggressive in terms of providing liquidity in the capital markets to make sure that companies had the ability to issue. And you saw a situation where we got very concerned, 2009, 2010, 2011, with that maturity wall. And a lot of companies actually didn't make it. We saw a very high level of default. The level and breadth of Fed intervention that occurred in March will be written about for many, many decades. And this Fed learned from previous mistakes. They went in big and they went in broad. And so providing liquidity to companies to be able to extend their debt term, we really don't have a rollover issue right now. So there's no liquidity issue for companies. And so the fact that they were able to extend their debt leads to much less of a near-term concern. Leveraged loan market, there was a little bit of a slowdown. There was the inability initially for companies to fund. But what you found is that the CLO machine has picked back up. And investors like us are looking at the loan market and saying, well, I'm getting potentially better recoveries in the leveraged loan market. Investors are very fearful that rates may not rise, and so individuals have been selling loans. But we view actually the loan market as a very, very attractive opportunity. And again, companies have extended out the debt. The CLO machine is there to provide support. and there's a lot of very attractive high-quality spread there. So people talk about the low-rate environment and that how can you make money at rates of 1-2%. The credit market still offers some opportunity. It may not be in the investment-grade market that has seen that recovery. It may not be in the Treasury market, but the credit market still offers some opportunity.
Mike, always great to catch up. Fantastic to hear from you. Mike Swell there of Goldman Sachs Asset Management. Thank you very much, sir. That does it for us. That does it for Bloomberg Real Yield. More from us next week. This is Bloomberg.